on the final discussion on the course I've been teaching on the history of money, banking, and credit. And tonight we're going to have generally an open discussion. And some of you who've been attending other lectures and courses on the similar subjects offered by the school may have some thoughts to share with what you've heard from others besides me. But to get us warmed up, I have come up with quiz questions that I'm putting to you to see how much you've retained from our course that we've had over the last 8 weeks. So you'll see on the screen, the first question I have up there is, cattle, beads, salt, whiskey, and tobacco are forms of what kind of money? Anyone have an answer?
Commodity.
Very good. Second question, why did Greek and Roman merchants use bills of exchange to conduct business?
Metal's too heavy?
Well, that's part of it. Pretty close.
Too awkward.
Anybody else have a thought? Much easier. Much safer. Wayne, did you want to?
I said safer.
Okay. Yeah, and I need you to mute yourself because we're getting the feedback from you directly for some reason. But anyway, yeah, it's safer because the actual money doesn't have to move. You just make a bookkeeping entry with, in the books, and eventually at some point in time, you might settle the account by actually moving the money. But bills of exchange make it a lot easier. How is credit created? How is credit created?
Double entry bookkeeping.
Well, that's an interesting answer, and that's how it'd be recorded. But certainly, how it's created. Think about that. I cannot create my own credit. I have to get credit from someone else. Someone has to extend credit to me, to trust me that I'm going to pay for whatever good or service I receive sometime down the road, whether it's informal or much more formal. A blank was first used in 2600 BC for what purpose?
A coin.
Good guess. I didn't write that. It wasn't a very great question the way I wrote it.
No.
The answer I was looking for is a touchstone. And a touchstone was first used in 2600 BC for what purpose? Anybody remember what a touchstone is for? To determine the purity of gold or silver, of precious metal. They figured out that this touchstone had the ability, when you scrape the precious metal against it, it would reveal its purity. I don't know how that was done, but that worked. Next question, which European family emerged as banker to the Catholic Church?
The Rothschild.
Pardon me?
The Rothschild.
Nope.
Okay, Medici then.
Medici.
Yeah.
Guess number 2 was the right one.
Okay. Italians.
The Bank of Amsterdam, established in the early 17th century, was what type of bank?
Was a public banking, right?
Say that again?
Wasn't that an example of public banking that?
Well, it was in fact a public bank, yes.
Full reserve.
Full reserve.
Full reserve, yes. It actually, the term I was looking for was deposit bank,
Yeah.
but full reserve would satisfy the answer on that one.
Okay.
What is the law of money named after the English financier Thomas Gresham?
Bad money chases the good one.
Bad money chases out good. Yeah. So when coins were in circulation, made out of precious metal, over time, they're going to wear thin a bit. Some of their gold content is going to disappear. And so as long as people are willing to accept those coins at par value with coins that are newly minted, people will hold the newly minted coins and circulate those that have actual less real value than their stated value. What are the two primary responsibilities of the Federal Reserve System?
Fighting inflation and full employment.
Okay. Anyone else have another one? Regulating interest rates,
Okay.
regulating the cost of borrowing. And with regard to fighting inflation, what grade would you give them?
Well, I don't know, because the way they fight inflation is through regulating interest rate. When they see it's going up, inflation is going up, they just kind of raise the interest rate and vice versa.
Well, you might remember I showed you a chart that showed the declining purchasing power of a dollar.
Mhm.
You
So-
got a discount rate. The discount rate,
And the discount rate is a tool, certainly. What the Fed charges its members banks to borrow from the Fed. So the two main responsibilities are try to prevent inflation and do their best to stabilize, the economy. And
Don't they also serve as the clearinghouse for
yeah,
the banks?
yes, that's correct, Marty. Those are all functions, and some of them, the mechanics, they do very well. They have not done a very good job of controlling inflation or with achieving economic stability over time. So that's why there's so much discussion about whether the Fed should be restructured, reformatted, or done away with, or given different powers, authorities. So what did Benjamin Franklin mean when he wrote that the use of paper money, quote, operated as a gradual tax? What do you think? It operates as a gradual tax, paper money.
Well, inflation basically reduces the value of the paper money over time.
Exactly. So it's a tax on your purchasing power, but it is a tax that's generally so gradual that people don't pay much attention to it. And Franklin thought that was a very useful thing for government. What action taken by President Andrew Jackson in 1833 changed the structure of bank? Wayne?
Well, head of the Second Bank of the United States put an end, I think vetoed the renewal of the charter, and so the Second Bank of the United States stopped, and that was our last so-called central bank until 1913.
Excellent. Thank you. Thank you. I need you to mute yourself again. Yeah. Andrew Jackson took all the money out of the out of the national bank, put it in state banks, and then when the charter came up for renewal, the bank went out of business. Another name for the period of free banking in the United States during the 19th century is these two words.
Wildcat banking.
All right. Thank you. What is bimetallism?
Sounds like that might be the use of gold and silver.
Gold and silver.
Right. It's the idea that our coinage ought to be made out of either gold and or silver in some fashion, and that those bimetals, those metals should back the paper currency in circulation. So in the United States, during the early 20th century, we had gold certificates and we had silver certificates as part of our paper currency. Next, does the US government manage the Federal Reserve System?
No.
No.
That's actually correct. I mean, the government certainly has some powers of influence, but the Federal Reserve is supposed to operate independent of political influence, and it's owned by its member banks. It's member by commercial banks. So the Federal Reserve System is not really a government run central banking system. What influence did the Crusades have on the systems of money and banking?
That was a long time ago.
Yes, it was. What did our friendly European crusaders do when they finally made it to Constantinople?
If
They
robbed.
They robbed the city. And they brought back everything they could get their hands on, including a lot of precious metals. And so that dramatically changed things in Europe, because what had been a system largely based on the collection of food commodities and payment of rents and tithes now became a system, a market system where money was exchanged. So there's a lot more money flowing in, and merchants in the Eastern Mediterranean demanded the payment for their goods and services in hard money. So it changed the system of feudal reciprocity into a far more market-dominated, money-dominated system. Shaving of the edges of ancient coins does what to the real value of the coins? There's a term here.
Lower
Well,
the value.
It definitely lowers the value. There's that's debase, exactly. That's the term I was looking for. Counterfeiting them is not quite the right term, but counterfeit coins were made from the shavings. So you have 10 coins, you shave them all, you get enough shavings to melt the rest down, and you create a 11th coin, which is counterfeit. After the First World War ended, Britain attempted to reestablish its currency's predominance by taking what action?
Well, went back onto the gold standard, but that was kind of self-defeating in a way.
Yeah, you're right, Wayne. They tried to go back on the gold standard at pre-war parity, but of course, inflation had occurred, and so it proved to be impossible, and Britain really suffered for several years. Does anybody remember who was mainly responsible for making that decision?
Winston Churchill.
Yep. Winston Churchill was the Chancellor of the Exchequer, and he made the decision. Keynes tried to convince him otherwise, but no one was listening. The International Monetary Fund and the World Bank were established as a result of agreements reached in 1944 at what conference?
I think that was Bretton Woods. Right?
All right. The commonly used name for peer-to-peer electronic cash systems is?
Interact. Bitcoin.
I'll take Bitcoin was the word I was looking for.
Oh.
Really?
Which US president finally took the United States off the gold exchange standard?
Tricky Dick.
Nixon.
Tricky
I
Dick.
call him, yeah, Tricky Dick, yeah.
Another name for the Federal National Mortgage Association is
Fannie Mae.
Fannie Mae. I had to get one in there from,
Undertaker's Anonymous?
pardon me?
Undertaker's Anonymous?
Oh my. What did the repeal of the Glass-Steagall Act accomplish?
Financial deregulation.
Okay.
Banks could lend money to themselves and then speculate with it.
All of that.
No,
All of that.
it separated the act originally separated the commercial
Investment banks and
commercial banks from deposit banks, right?
Exactly.
Uh,
And so now there's almost no restriction on commercial banks buying investment banks and vice versa, or buying other financial institutions. So we have a world dominated by bank holding companies. And I would hate to try to do their consolidated financial statements. What distinguishes the Bank of North Dakota from other banks in the United States? This is our final question.
Publicly
It's the
owned.
only state bank in the US.
Correct. All right, you all got a passing grade. And so now I'm just going to open it up for general discussion. I know Dev had a subject he wanted to bring up. Dev, why don't you do that now, and we'll have start with some discussion about that.
Hmm.
Are you there? You are there, but you've got your mic on mute. Everybody calls you Dave, but your name is not really Dave.
It is Dave. It is Dave.
You go by Dave.
No, my full name is Dave Preet. That's how you pronounce it.
I see.
Dave
So,
Preet.
yeah.
Well,
But-
now I can call you Dave and feel confident that you'll know who I'm
Yeah,
talking to.
Yes.
Okay.
Yes, no doubt. Sorry, I was away for 30 seconds. I'm back on my desk.
So you had sent a message that you had an idea about something you wanted to talk about. So you're
Yeah.
up.
You wanna get out and get some water?
Let me get my.
No, thank you. Oh, maybe.
So what I would like to say is, money or currency represent the need of people to trade for needs, and gold is not even a real need of the people. And to start the topic, I'll say a little story, and I'll add a few things to it, because I say this because young entrepreneurs these days, they come up with this Bitcoins and they use the term mining. So they believe that the money comes from mining itself, mining gold, but that's not true. That's not at all true. To give a little bit of example or where I come from, I have lived all my life in different places in the world. At one point, my dad was posted in remote India, where was British Railway set up, and setup was made to extract mineral from there and transport. So British has gone, and so my dad is posted by Indian Railways there.
Quarter tea, 3/4 water.
So the story is about, there was one guy who was dressed in tribal clothing, will come down to our place, and he will bring in a stack of wood and sell it to my mom and ask for $2. So he will come a couple of times, and I one day want to follow him, what he does with this $2. So this guy was a tribal guy who lived down the river on top of a hill or mountain. I couldn't see Kevin never reached his village, but I was able to follow him to the river. But what he did was he would come to our place, sell this piece of a little bit of wood and get $2. And from the $2, he will go to a nearby place and buy a bottle of liquor, which was which is minimal cost. And liquor was made from local fruits. So it cost him that, and it will go away. So what I want to tell you from the story is he was self-sufficient. So internally in his village, but in order to get a liquor, he needed a foreign currency, which is $2 from my mom. And that's how he was able to afford this luxury. So in a nutshell, every nation should be able to print their own money and sustain themselves by printing as much money they want. But if we want to do international trade, they should use an international currency. America is trying to put US dollars as international currency, but some other countries are not allowing to do that. But we should really think about this to make international currency for international trade. And internally, it should be their own currency, because the food, shelter, and clothing are different for different people. People living in northern Ontario in igloos, their housing needs are different compared to those who are living in Florida. So based on the housing needs, based on food needs, and based on the clothing needs, the governments can print their money on their own. But for international trade, they should have separate currency. So that's my 2 cents worth for today.
Well, reactions. Any thoughts, comments back to Dave?
Well, I think they've been doing quite an experiment in Europe for the last 30 years or so, right? Since the euro was put in place, and they've had some challenges for sure over the years, especially with the situations in Greece and Italy and Spain and Portugal. I guess they call them the spit countries, but they seem to have been managing pretty darn well. And I think England was the only member of the common market for a number of years who chose to go their own way with their own currency. And now they're moving out of the.
Hang on a second.
Yeah, we had an echo going on there. So,
Yeah.
and now, of course, they've voted to move out of the common market altogether. So,
Yeah. Wayne, when you want to enter into the conversation, could you raise your hand, that yellow hand? That way you can be recognized, and then you can turn your mic on. Okay. Okay. So you've got your hand raised. I'll let you jump in.
Yeah, Great Britain was true, had kept his own currency, didn't go to the euro, but there are other EU members that also kept their own, particularly Denmark and Sweden as well. That's why I mentioned that. That's all.
Well,
thank you.
My own thought on this is that some countries have a strong enough domestic production so that their own currency, their sovereign currency, would serve their needs. But there are many countries that are not able to produce under their existing system of government or their existing system of public revenue, a sufficient, even a subsistence level of essentials for their population. So for some countries, I think what Dave, you've suggested works quite well. For others, not so well. Anyone else? Well, Dave, do you have any further comment? Do you want to respond to what you've heard from others?
No, it's just a thought that I came up with after listening to all your all your presentations. So I think we should go to the next talk and let's analyze the next talk.
All right. So anyone else have anything on your mind based on the course? Maybe my quiz questions have, raised some issues that in your mind that you want to bring up. Joe, your hand's up.
Yeah, I do want to discuss something related to the course, but I'll save that, listen to other people. But I did want to make a couple little announcements. I put in the chat that tonight there is a Alliance for Just Money coffee house on digital money. Friend or foe is the title, and I put a connection to the paper in case it doesn't work out in terms of people having an opportunity. There's a paper by the young man who is going to be speaking. The second thing.
What time does that start?
It starts at 8.
Okay, so when we're finished here,
yeah, exactly.
Those who want to continue this discussion can jump right on that.
Right, and you want to register before that so you get a link. The second thing is I wanted to bring people's attention to the Economist magazine had quite a special section on money in CBDC. I put that link in just now. There's a video that's a very nice short introduction to it, and it does deal with the nature of money. Obviously not in the wonderful detail you provided, but it's very useful. And there's a whole on below a YouTube entry is often an expanded note. You click on show and you see more, and there's a whole bunch more links to articles. You may have to create a few logins so you can see them all, but I think you get 3 free articles with each login. But it might be very useful for people. So those are a couple of things of interest, and I'll get back in the fray later. Thank you.
Okay, thanks. Yeah, I certainly, as the programs that the school has offered, and a number of people who signed up for the lectures and have continued to come every week after week indicates there's just tremendous interest and concern about our financial system, our money system, and banking system. And I can only wish there was the same level of interest in our land ownership system and our tax policies regarding land, so that they would be treated at the same level of intensity that are being raised with regard to finance. Richard.
Yes. Hi, Ed. The slide about the independence of the Fed kind of jumped out for me. That to me has been kind of a psychopolitical type of thing that's been built up over the years, but the legal history doesn't bear that out at all. It's the Fed is like what's called a fiscal agent of Congress, and Congress is supposed to be kind of the boss, and the Fed is supposed to be its agent. So I don't know where that relationship changed, but in the public's mind, but it's got to somehow be reversed.
Well, the act that created the Federal Reserve System has been amended, and the government oversight of the Federal Reserve has been modified, from decade to decade. And certainly a big impetus for that was with the problems that occurred during the Great Depression. But my reading of the statute still indicates that that the Federal Reserve banks are owned by their member commercial banks. The profits under law are returned to the U.S. Treasury. However, I think it's 6% is the profit that the Federal Reserve System can retain, and everything else goes back to the Treasury. But I have to admit, I haven't studied the evolution of the statutes. So there may be someone else who has done that to see if any kind of specific status has changed since the original act was passed during the Wilson administration. But I hadn't heard or read anyone say exactly what you told us. Although I'm not disputing that it isn't the case. I'm not familiar with that interpretation.
It's kind of related to the confusion about the relationship between the coinage clause in the Constitution and the borrowed money clause. Most people think the money comes from paper money comes from the coinage clause, but the legal history is that paper and electronic money come from the borrowing clause, and they borrow on Congress's coined money. And the Fed kind of flipped that around in 1934, 33, and the Federal Reserve note became legal tender and not redeemable for coin. That's when it really got its independence, but it wasn't a constitutional independence. It was
administrative.
Yeah, the debt notes became legal tender, so were forced to accept them. So
right.
I don't know if it was intentionally done as a deceit or
expediency, perhaps.
Yeah, they're probably trying to build up for fighting Hitler or something, and they they did something kind of that wasn't quite kosher. So I don't know. But that the coin should always be the Federal Reserve was supposed to be they created an elastic currency. They're supposed to help Congress borrow on the coined money, and that was where the elasticity came in.
Yeah, the language in the Constitution gives the federal government the authority to coin money.
Right.
You
And
know,
metallic coin, not
exactly,
Right.
and to establish the value thereof,
Right.
which opens the loophole for coin money that it's really not. It doesn't have intrinsic value. So, yeah, they didn't craft the language really well and left a lot of opportunity for situational ethics.
Yeah.
I guess.
What's really odd and hard to accept is that the current coin that we have today, the tokens, is really the only money that's authorized by the Constitution. And
Yeah.
paper and electronic money is a borrowing of that. So that that ultimately the coined money is the only money.
Does that suggest to you that if the U.S. Treasury decided to issue again legal tender notes, that those notes would have to be backed by something tangible?
It would merely have to be redeemable for current coin, and that's easy to do. There's nobody's gonna.
Yeah, I mean, a current coin is tangible,
Yes, right.
but so I'd be able to go to the Treasury and say I'd like $100 in dimes or $100 in quarters.
Yeah.
But I couldn't go there and say I would like $100 in a gold coin.
Right. Right.
Yeah.
That ties it into labor and it grounds the system. So that's really all that's needed.
Just another indication of how difficult it will be to put the genie back in the bottle.
I know.
I think Joe's hand was back up first and then Wayne.
Yeah, from what I've read, I think Richard has it right. But this comment about the coin fits very nicely into the CBDC again, digital coins, right? And you could essentially turn the money supply into 100% money from, as per Fisher or the Chicago plan or whatever. Just wanted to say I quite liked your point about the land side of things. As you said, people are very interested in money, and the land issue has to be part of that equation. And I think a big reason for that is even if the money system was fixed, let's say we went to a Chicago plan or whatever monetary preference anyone might have, that the economic rent, the unearned income, would just explode until we fix the land side. If everybody had a job and everybody was making a living wage, so many more services were being provided and so forth, the wealth that all of that would be producing would be largely extracted by the land. Wealth extraction is a big, danger in our current land ownership situation, and the Henry George approach would make sure that wealth extraction didn't take place and that all of this wealth would be more evenly distributed. So I think you're quite right. That's a really, really important factor for people to think about. And the monetary reformers should be listening to you on that. They're forgetting that side of the wealth extraction.
This is why we have to have a seat at those of us associated with Henry George's ideals have to have or do our best to have a seat at that table, so that those perspectives are put on the table. And there's a growing number, not a huge number, a growing number of what are economists that are self-describing themselves as heterodox, that are beginning to see that direct connection and are starting to write in that vein. And all I can hope for is that as time goes on, that community of people in the economics discipline will grow, and more in the political realm will start to pay attention to that, to those arguments. Wayne?
Oh yes, regarding the ability of people to exchange paper money for gold and silver, I think for individual Americans that for gold that stopped in 1933, with the up until late 60s, you could actually exchange the American silver certificates, which were circulating as paper money, for silver at $1.29 an ounce. That stopped. It doesn't have to be gold or silver for that to there to be a problem that way. Canada some years ago had a problem because their 5-cent pieces were pure nickel, and there's more than 5 cents worth of the nickel in a Canadian 5-cent piece. So they switched because of that. They switched their composition of the 5-cent piece to what we have in America, namely mostly copper. It's copper nickel now.
Well, isn't that now the case with our pennies?
Also, it's true with our pennies made before 1982 were almost entirely copper. They were mostly they're bronze, but now since the beginning of 1982, they've been zinc pennies with a copper plated they're copper plated. They look like the old pennies, but they're not. They're mostly zinc.
And the commodity value of zinc is less than copper.
Less, but there's more than the pennies worth of copper in pre-1982 American pennies. Just like there was, there's more nickel in a Canadian 5-cent piece, and more value in the nickel in the Canadian 5-cent piece than the factually the 5 cents.
Well, we haven't yet reached the day of our coins being made out of plastic, but who knows?
There have been that has been done. Australian paper, what you think of as paper currency in Australia, and I think some other countries have followed suit. Canada's followed suit, are actually a form of plastic now. Canada's that way too. Australia, they're not paper. They're actually plastic, but you can fold it handle it like paper.
Yeah, well, I was just thinking of coins that you put into a vending machine.
Yeah.
Could they be made out of plastic?
I think there was a case. I think Japan did that during or shortly before or during World War II. Tried it.
Okay, Wayne, would you mute yourself?
Yeah, I'll mute myself.
I'll get Dave the floor again.
My question is about the brick money that you talk about. Like if we're talking bringing land value into the currency, then so should we not use your brick money and create something with that?
Well, asking my opinion, of course, I think that the opportunity to issue currency denominated in brick value has real potential. I learned recently that the idea came from the public choice economist James Buchanan. There's a lot of controversy about Buchanan based on his political ideology, but I don't know if the person that I got the idea from got his thinking from Buchanan or not. But I again, I made the case for it based on the fact that I think bricks have all of the positive attributes of precious metals and none of the negative. So, while it sounds really like a strange idea on the surface, it's something that I hope will stay on the table and somehow get more discussion down the road. Mike.
Sorry, I just want to add something. Is that okay?
Yeah, sure.
So brick, maybe you're thinking bricks sitting on a stack somewhere. No, brick also represent population density. If in a city where there's large amount of bricks used to construct a house or construct a bunch of houses, the population density is high. It means that area should have more money required in circulation. So that it kind of bricks kind of represent, I would say, population density. Yeah, and based on population density, we can print more money for that country or that region kind of thing. So that has one more. That's my thought, I guess.
Okay. Well, it's not necessary in my mind to have warehouses full of bricks because they can be produced so easily.
No. I don't mean that at all. What I mean is a cluster of houses which has brick any or brick value into it. So it doesn't matter even if you make the house in plastic, it doesn't matter, but it has a brick value to it, which is supporting so much amount of population.
Okay, yeah, yeah. I think I understand the connection you're making. If I have a brick home that has 10,000 bricks in it,
Yeah,
then its basic costs of its component parts are at least $10,000.
exactly.
Yeah. Okay. Mike.
Just comments on Canadian money. We gave up a penny because it had 3 cents worth of copper in it. And we do have plastic bills, and you don't want to put them in a hot dryer because they shrivel up.
Yeah, well, so innovation doesn't always, there's law of unforeseen consequences working for some innovation. You have to test it first before you roll it out in full. Now I have Dave's and Wayne's and Joe's hands still up. Which of the three of you has another question? We haven't heard from a lot of folks I'd like to hear from who've been quiet all through tonight and often through the entire course. So it'd be great to hear from some of you who have been quiet, just, listening as lurkers. Joe, go ahead.
You mentioned that some academics are starting to look more at the land issue. And kind of nice if you let us know who you had in mind, but I did put a link in there about an article by Richard Florida, who is a respected academic in the Rotman School here in Canada, which is a highly respected business school. And he wrote nicely, a nice article, good long detailed article about the issues of land and, a functioning city and so forth. And he talked about Ricardo and the economic rent and the whole thing. So I put that link in. The second link I'm putting in relates to Buchanan. He, at the very end of his career, at the very end of his life, he's in a couple of YouTube videos about the financial crisis. And he's talking about Simons. I'm trying to remember his first name.
Herbert Simon?
Herbert, the Chicago Plan Simons.
Julian.
And he wrote an article in the Cato Institute of all places, which you would expect from the libertarian type. But it was entitled, and this is the link I just put in there, The Constitutionalization of Money. And essentially, it was kind of a road to Damascus kind of moment for him, where he looked back on, I'm not sure if he mentioned in the article, but I had heard him say it, I'm sure, in one of those videos. He was looking back at his days at the Chicago school, which he attended, and Simons was an influence on him. And admitting that money was something different. It had to be a public utility. It had to be handled by the government. It was not, part of his kind of highly libertarian free market thinking. And it was quite an admission. And that was based on what he had seen take place in the previous couple of years. And I guess what Bernanke had to do, and all, it would have taken him back. It's much like, I don't know how many have read the Chicago Plan by Ronnie Phillips, but the foreword is by Minsky. And he makes kind of a similar comment about Phillips recapturing the memory of that period. And Minsky too was taught by Simons, and he went to several schools, but he definitely was, when you look at Wikipedia, Simons and Fisher were influences on him. And it was almost like his association with Phillips at the Levy Institute kind of recaptured those memories and what those scholars were saying. And Buchanan seems to have gone through a similar thing because of the Great Recession. And it is an interesting paper. He's not pretending to be a monetary scholar, but he's thinking back to Simon and that period.
Well, you asked, for a couple of economists that I would put in that group. Well, probably at the top of the list from a standpoint of mainstream exposure would be Joe Stiglitz. And Polly Cleveland's on, and she knows Joe Stiglitz and may be able to say a word or two. And of course, Michael Hudson has pontificated extensively on both the money and the land question, and there are others. Jerry, your hand is up next, I think. You have to unmute yourself, Jerry.
Okay, have I done it?
You have done it. You're on.
Okay, I have a word about the monetary standard. One of the essential qualities of a monetary standard is that it should be perfectly useless. This is one of the defects with gold because it's extremely useful. And your bricks are extremely useful. The best money system I've come across is in a South Sea mountainous island. Laborers go up the mountains and carve out of the mountain a giant stone donut, a huge donut, which is used as their monetary standard, and it fits everything. It's very hard to come by. It takes an awful lot of work. It's recognized by everybody on the island, and it's perfectly useless.
Yeah, well, I mean, so in a sense, the lecture I gave on what Henry George thought about money, supports that it shouldn't, be tangible. There shouldn't have any tangible value to it.
Exactly.
However, I have to resort to my own in study of the history of banking, and I still believe very strongly that the Bank of Amsterdam, during its years when it issued receipt money for full reserves, produced the longest period of non-inflationary economic growth
Absolutely.
To that point in history.
Your reserve requirements now are what, about 11%? I mean, it's absurd.
Well, the reserve requirements aren't really reserves of anything tangible.
Yeah.
Again, they're only reserves of government securities or, legal tender paper currency or basically bonds and notes. So I think there's a lot of room for continuous discussion on this point.
Okay, thanks.
I'll be prepared to be convinced to change my mind if anyone can give me the strong enough arguments, and I hope that others might be willing to consider the idea that we still might need something to back our paper currency, and that that bricks serve pretty well in that capacity. Brendan.
Okay, thank you. Let's see, how do I do this?
Hi, thanks, Ed. Sorry, this is not a question, more of a clarification. This is from the Southern Hemisphere, so we're subject to the tyranny of distance here. But I hope I'm not verbaling you here. That I think you said that the U.S. government, and I don't know whether you meant the Federal Reserve because I don't understand the arm's length approach there, but made $15 billion out of bailing out the banks during the GFC. I've never seen that figure before here, but Is there some paper about that?
Yeah, I'd have to go back to my slides to find the source. But the bottom line of the story has been in the United States that the money that was loaned to corporate entities that were having financial difficulties, cash flow difficulties, was eventually all repaid, including interest, so that the federal government actually made a profit. Now, you'd have to do a lot more analysis to determine if it was an above market or below market return. But basically the argument is that we as a society didn't lose anything by funding the bailout of those entities.
So it was all loans, was it, rather than any equity infusion?
Well, here again, for a time, the federal government became an owner of General Motors. I don't know, how much stock they acquired, and they purchased troubled assets. So that's another issue. When you purchase troubled assets, the question is, did you pay the accurate market value of those troubled assets? So, for example, if you have bonds that are currently yielding 5%, and that are yielding 5%, that's their note rate, and the current rate of interest is 10, you're not going to pay par value for that bond. It's going to be discounted based on the difference between the current rate of return and the nominal rate of return. So just like when the Resolution Trust Corporation was formed to deal with the S&L bailout, if those assets were properly valued based on their troubled asset value, then the federal government didn't overpay. And so when the economy started to recover, those assets recovered value. The assets are sold. They recouped what the federal government paid for them plus some. So, but it's a case by case. And what I gave you was a bottom line number that was reported in some financial report. I don't remember if it was Bloomberg or The Economist or Wall Street Journal or where the source was. Somebody else may know that's the details a little bit better than I do.
Okay, thanks. And just to confirm that I believe we still have paper currency, plastic currency in Australia, but I haven't seen any for 12 months. So things may have changed, but yeah. Don't put it in the...
Is plastic currency easier to put disinfectant on rather than paper currency? To prevent the transmission of the COVID virus?
Yeah, well, luckily we haven't had much problem here. So the currency, and we've been a paperless or plasticless economy for 12 months. So,
yeah. Well, for the last year, many of us have been reluctant to accept paper currency. I used our credit card or debit card or whatever for almost everything, so that we don't have to touch the paper currency. If I bring paper currency into the house, my wife instructs me to take it into the laundry room and wash it.
Right. Yeah. No, the same here, but no, we've been lucky here, so less of an issue.
Guy, we haven't heard from you yet, so why don't I give you the floor?
Okay, thank you. I got three facts that puzzle me. The first one is about Donald Trump. At a certain time, he was asking the European nation to participate for the OTAN for military. And the Germans said to him, if you want us to participate, we need to take back the gold you have. We're holding with you. And he said nothing. After that, he dropped the case. He never asked them anything.
Are you referring to Trump's demand that the European nations who are members of NATO begin to pay their fair share?
That's true.
Yeah.
Yeah,
I don't know the second part of that story. Maybe someone else does. That the response from the German government was, well, you know, we have a positive trade balance, and so if you're going to ask us to pay for NATO, then we want our gold back.
yeah. No, because they store, they have a lot of gold here. You know, most of the European nations, they have the gold. They store the gold here. So nobody talk about that gold because it generates a lot of interest. So now,
well, the gold stocks, I mean, it's simply an accounting record. If the balance, the gold balance that Germany has against the United States, and the gold is held in Fort Knox or in the Federal Reserve Bank of New York or whatever, on the books of that institution, Germany would have a debit balance in the asset column, so that if there was eventually some sort of
there's a lot of things. There's a lot of things people don't talk about. You know, when you got a gold certificate, you receive 6% per week.
Per week?
Per week.
I don't know what that is. Does anyone else know? I
see. You know,
I'll take a return. These days, I'll take an annual return of 6%. If I can get 6% per week, that's one heck of an asset to have.
You know, let me give you. You know, that's why I'm quite puzzled. You know, since 1982, the gold standard here in the United States passed from $35 to $42.29 grain. You know, is in Title 31.
Well, yeah, but gold was freed up from governmental control, so gold went to whatever market price people were willing to pay for gold. You know, Richard Nixon took us off of the gold exchange standard and said, you know, from now on, the dollar is going to float, and we're not going to, you know, pay our debts in gold. So I seem to remember, and someone else can confirm this, at the time, the market price for gold in the London exchange was significantly above $35. I don't know what the price was at the time, but so now it's just it's a speculation driven market. And
I understand what you're saying. You know, there's a lot of things we it's not published. It's not published. Like
well, here's my response to you there. Often the details are published, but you have to read the footnotes. it's
okay.
Yeah,
okay.
Yeah, that's and
you know, by law, you have to print a certain number of bills every month. You know, the number, the dollar bill, the $2 bill, the 5, the 10, the 20, the 50, and the 100. Now, every note over the 100 notes, there's a fix. Is fixed. Every month is the same number for the last 50 years. And they bear interest. All the notes isn't if you go to the Fraser, you know, the St. Louis Reserve Library,
yeah,
is in there. So, but you know,
well, I don't know about. I mean, you're entering into territory I don't have any knowledge of, that I fully admit. But all I do know is that the Federal Reserve System has it's like an expectation of how long paper currency will remain useful and in circulation. And so they're always pulling currency out of circulation that's worn out or nearly so, and then printing new Federal Reserve notes to replace that. Now, I don't know how much that's been going on in the last several years, given the quantitative easing that's really been digital. So how those details are worked out, I have no idea. I don't know if it's simply an administrative decision on the part of the governing board of the Federal Reserve, or there are other considerations. Does someone have any information on that specific issue you want to share? If not, I'll give Mike the floor and then Marty.
Okay, thank you.
Yeah, I want to say a few things about that, those big stone donuts. There was one, it may still be there in the Bank of Canada building in the lobby. It's about 6 foot high, and the hole in the middle is only big enough to put a stout log through so that a team of people on either side can carry the things. And occasionally when the balance of payments between the islands got out of place, they would actually transport one of these anchors of the currency from one island to the other island. And my question or my inquiry is to find out if anybody has a sense of what anchoring a currency means. Apparently one of these boats transporting one of these big stone currency items capsized, and it went to the bottom of the ocean. They never bothered to bring it back, but everybody always knew who owned how much of that particular anchor, even though it was at the bottom of the sea.
I can't, it sounds like a very, I don't know, bizarre kind of solution to a practical problem that certainly could have had a much simpler solution. But people do come up with strange solutions to practical problems and then somehow get consensus agreement and move forward until that idea is proven to be not workable.
And the simpler it is, the easier it is to counterfeit.
Yeah, that's true. Just as with the coins that had no ridged edges. Marty, I think you're next.
Okay, so I think it was last week, possibly you touched on the topic of cryptocurrencies, and of course they've been very volatile the last couple of weeks. But one of the things that I've been reading about is the number of major corporations, many of the Fortune 100, that have been dabbling in cryptocurrencies. In some cases, they're writing software to support the exchange of cryptocurrencies, or using cryptocurrencies as a method of exchange because they can circumvent the need to change from one currency to another. If they both agree, two different corporations, for example, are selling products to one another that and they're based in different countries. So instead of having to switch back and forth between yen and dollars, and there's a certain amount of fees involved in doing that, they both agree to use a particular cryptocurrency. And I understand that the Ethereum currency is the one that's most popular for that kind of corporate exchange, and that IBM is one of the companies that's actually spending a lot of money on research on how to actually facilitate that kind of exchange. So I'm just curious, since that will be outside the bounds of the normal country-based currencies, how you envision that might impact international trade going forward.
Well, from my standpoint, it's certainly an innovation that has merit. From the standpoint of governments, it's an innovation that basically interferes with what most governments see as their regulatory role and their ability to tax all cash flows, all assets, all actions. So as I said last week, India, the government in India is pushing for legislation that would eliminate the use of all cryptocurrencies in India. And I don't know, I haven't seen anything further on the progress, but I would suspect that India is not the only country that is looking at cryptocurrencies as as something that ought to be opposed.
I think actually the Chinese government recently, within the last week or so, indicated that they're clamping down on Bitcoin, and they've created their own countrywide virtual currency as
Yeah,
an alternate.
yeah. This is probably, I think, Marty, you've just hit on the probable trajectory of all of this, and that is governments will come up with their version of cryptocurrency to try to reduce or eliminate the private issuance of these currencies.
I know there was quite an uproar, I guess maybe a year or two ago, when Mark Zuckerberg said that he was thinking about having Facebook create its
Yeah.
own cryptocurrency. And
Yeah.
I think that he ran into some headwaters with the US government in terms of getting approval to do that.
Well, I haven't read anything since last week, and so the whole story is already moving very quickly in all sorts of directions. So yeah, the message is pay close attention. If you decide to invest in any of these cryptocurrencies, do so without exposing a large percentage of your assets to the volatility that is likely to occur.
Right. As many folks say, don't put any more money into them than you're prepared to lose.
Prepared to lose,
Because,
exactly.
Yeah. Well, thank you. Appreciate it.
Wayne, did you have another comment?
Yes, I did have comments. In fact, several. One is that the heavy stone currency you mentioned in the Pacific, I think was centered on Yap Island, in the Western Pacific. The other was the cryptocurrencies in the United States. I don't think our own government looks at it too kindly. In fact, if you look carefully at our current Form 1040 that you filled out this year, that on the front page of page 1 of Form 1040, they for the first time this year they've asked if you have ever acquired or bought or sold any cryptocurrency. That has not been on the tax forms in previous years. And the third thing is that someone mentioned about large denomination bills in the United States. We still have them, but they haven't been printed for decades. And they're collector's items, but it's legal to have them as long as you train them honestly. $500, $1,000, $5,000, and $10,000 bills. But they are not really in circulation. I've never personally owned any United States paper currency of a denomination higher than $100. So it's but they still exist, but they're not, in effect, not in use. Okay.
Thanks, Wayne. I do have one sort of comment about the tax return. Wayne, we need you to mute.
Oh yeah.
And as I wonder that back in 1933, when President Roosevelt asked everyone to turn in their gold, I wonder how many people, owned up to the fact that they actually had possession of gold in their private bank vaults or, security boxes or whatever. I suspect that compliance then was pretty low, and I suspect that compliance on the current form is pretty low. But it seems like that would be human nature not to disclose that unless absolutely required to by some sort of auditing. Anyone else who's been so quiet? I'd like to hear from others, questions or comments about the course or anything else that you've attended recently at the school and have a comment on. Is that an indication of happy consumers, or is it simply that it's dinner time and a lot of people are having their dinner while they're listening? Anyway, I see Joe has his hand back up.
Yeah, dinner. That's right. Can't forget to have that. Couple things. One, this whole discussion of the stones and Yap Island and so forth. It's interesting that both Friedman and Keynes referenced Yap Island. They were both quite interested in that. Of course, they're very interested in money, and that was something that caught their attention too. But this whole discussion, to me, kind of begs the question. We seem to forget the notion that money is really just an extension of our legal system. And whether it's a building permit or a professional license or issuing money, issuing any of those things and countless other things, diplomas and everything else, really money is just an extension of legal authority. And it's kind of nice because it's measured and it's a medium of exchange, and we try to keep it reasonably stable. It's a good measure of our wealth and so forth and exchanges, but it's just an extension of our legal system. And I can't remember which gentleman said it earlier, but maybe it shouldn't have any value of its own, because laws don't have a value. Permits don't have a value, intrinsic, that is. They are an expression of our legal authority. And it's an expression of our political will as well, just like a law is. And we can use money in that regard to accomplish far more. Keynes said, whatever we can do in terms of our resources, we can afford, because the money is just that. It's a decree. We're going to do this. And the money gives us the ability to decree those things. The Inca civilization didn't have money. Their authority was much more direct. They just were told what they had to do. The Chinese, to me, are the ones who are really adopting that approach best in the world. In Mervyn King's book, The End of Alchemy, begins the book and ends the book with an event that really affected him. He's talking to a Chinese central banker, and the central banker says how much they've learned from the West in terms of economics and so forth. They said, he said, in terms of money, we do that better. And the book addresses that.
If the Chinese ever come to an understanding that they should not extend credit for the purchase of land or accept land value as collateral for borrowing, they will have solved a tremendous part of the economic puzzle. The reason for a primary reason for inflation and instability. I mean, when in the 90s, I was invited by some of my colleagues, one of whom is on this call, Ted Gortney, to make a trip to Russia to talk to the Russian Duma about their process of privatizing their economic resources in their economic system. And my job was basically to explain to them the mistakes that we had made in the United States with regard to our financial system. And one of the points that I made during my piece of that presentation was exactly that extending credit for the purchase of land was a mistake, and it had all sorts of adverse consequences on the economy. What people don't really remember very clearly is up until the early 1970s, when you purchased a residential property, you were required, in most transactions, to make a 20% cash down payment. And the basic result was that you were paying cash for the parcel of land under your house, and you were borrowing the funds, generally over 30 years, for the purchase of a depreciating asset, which is the housing unit. So, the idea there is, as your loan balance pays down, the amortization of the loan roughly equals the depreciation schedule for the house that you're acquiring. So at the end of the 30 years, unless you've put more and more money back into it all the time, every year for maintenance, and then every 10 years ago or so for systems replacement. You have an asset that has, basically no value, and the loan is paid off. And we slowly but surely had to get away from that because land prices were climbing at such a high rate. And so we made all sorts of adjustments in our financial system to accommodate land price inflation. We replaced the 20% down payment with a much lower down payment requirement, and then required borrowers to pay mortgage insurance premiums. And eventually, by the time the 2000s came around and I was at Fannie Mae, we had some programs where we did not require any cash down payment at all. There weren't many, but most of the time, the minimum down payment was 3%. You had to get, financial assistance for the rest of the 5% down payment that was required. But it was an accommodation to what was happening to property prices. And the other part of that I've written about recently, thanks to Ibrahim, I had the invitation to write a paper for the Eastern Economic Association conference this year. And I wrote a paper on my reflections of being in the trenches during the financial build up to the financial crisis. And every year when the GSEs, Fannie Mae and Freddie Mac, would sit down to talk about maximum loan limits, they just kept jacking up the maximum loan limits to accommodate the increase in property prices. So it was like feeding on itself. Property prices go up. Well, if we're going to keep transaction volume up, we have to increase our maximum loan price amounts. And we also have to reduce down payment requirements. And we have to be more flexible on credit worthiness requirements. All sorts of changes had to occur in what I would say is standard prudent underwriting in order to keep the transaction volume up and keep the market going. Until, of course, 2007 came and the whole thing came crashing down. So we've made all sorts of adjustments to quote the market and market forces, but I think the idea that money is simply an externality is subject to a lot of discussion and debate, and that's why I'm still not convinced that digital money created out of thin air is going to do anything but create even the deepest, long-lasting financial crash that we've experienced even since the Great Depression. And if some of the people I know who are looking at the property market cycle are correct, it's 2026 when we are going to experience the really serious negative consequences of the decisions that are being made right now.
Just a little thought about your excellent point about using land as collateral. In a sense, there was a logic to it because 100 years ago, 70% of the people are on farms. 150 years ago, 90% were on farms. They were going concerns. They were productive things. And of course, as that has shrunk and shrunk and shrunk, very few people are occupying properties that they own that are productive. They're just places to live. They're not producing things.
Well, in the colonial period, of course, land was one of the principal assets that most families held if they were property owners. Their capital goods were not extensive, but the land was also not all that costly either. So why should a bank make a loan to someone? Well, they have to do an analysis of that person's activities and whether or not that person, that borrower, is going to generate revenue from what they're doing in order to satisfy the debt. And if there's any question about that, they're going to look for collateral, to be provided and put some kind of a mortgage or other lien on that collateral value. I will say this though, in looking at loan losses for mortgage investors, even with private mortgage insurance protection, if the effective loan to value ratio on a loan is above 70%, the mortgage investor usually loses money on foreclosure and resale of the property. And there are a lot of reasons for that. Property depreciation or deterioration. Sometimes the property gets vandalized very quickly after the occupants leave, or the occupants are inclined during the eviction process not to take very good care of the property, and so there's heavy maintenance requirements. So banks do take, or not just I won't say banks, mortgage investors, because most banks do not portfolio much of their property related loans. They try to find an investor to take them out. But right now, there's certainly a frenzy in this market of people, gobbling up properties at unbelievable prices. And I don't know, like I said, as we get closer and closer to 2026, anyone who's acquiring property toward the end of that cyclical period is probably going to take some really serious hits on their investments. Dave, I see your hand is up again. Although, I'm sorry, Guy, your hand is still up. Did you have further comment first?
I would like to ask you, I don't understand why they let me change the way I put the question.
Okay.
$1,000 today would not be the same $1,000 in 20 years, right?
Probably not.
Okay, so but when you pay the mortgage, they don't include that depreciation of the dollar.
Well, this is why mortgage by bankers that originate mortgage loans will, in these uncertain times, are not going to hold those loans in portfolio. They're going to try to sell those loans to investors, or they're going to pool those loans together into some sort of mortgage-backed security or collateralized mortgage obligation, which then acts like a bond and which can be readily sold if in fact the value of that asset starts to move against them. So they can minimize the losses if there's market volatility.
No,
does that answer your question?
You see, when I pay my mortgage, during the life of the mortgage, let's say I have to pay $200,000 at the end of the mortgage, $200,000. But the $200,000 that I have to pay depreciate over the life of the mortgage.
Of course, yeah. Well,
Okay,
I mean that's been our experience. So the argument, the case
in
you're
reality,
making,
I may have paid 165 instead of 200,000. Why I have to pay? I still have to pay the 200,000 when the dollar depreciate over the life of the mortgage. That's my question.
well, I'm sorry, who else jumped in?
I just spoke. You finished, and I'll say something.
If you borrow money at a fixed rate of interest during a period where there's continuous inflation, then you're paying back the loan to the lender with money that has less purchasing power than when you acquired it. Yeah. So you as a borrower are experiencing the benefits of inflation, at least in that transaction. So that's the reason why the worst thing for a financial institution is to lend long and borrow short. You have to do all, you have to, as a financial institution, you have to adjust your activity to match the duration of your assets and liabilities, and you have to factor in all these other risks that are concerned. So, the institutions that have the best black box to put all these factors in and run their algorithms and come up with the right mix of investment strategies, they're the ones that don't require a bailout when there is a financial crash. But we know that many financial institutions aren't particularly good at managing those risks. And so periodically they have to come for a bailout, as do many consumers. So, this is why if you're looking to buy a residential property, a new house, a new property, it's good to know how close you are to the top of the market. And because if you buy a property at the top of the market and there is a correction, then all of a sudden the collateral value of your property falls below what you owe to the mortgage lender and investor. And so it leaves you underwater unless and until the property markets recover.
Okay, thank you.
Dave.
I like to add to that when banks create or calculate the interest rate, that includes the inflation in it. So otherwise they will, if they feel the value of the money is going to go down, they will increase the interest rate to take care of that.
Well, the banks, individual banks can only do so much, or they will lose transaction volume.
Oh yeah.
So it's still a very competitive environment. And of course, the Federal Reserve, by its discount rates, directs what the interest rate environment will be. And then look, you have people on Wall Street and all the banks, and they're looking at the bond markets, and they're looking at yield curves, and they're looking at the stars, to see when all the stars are aligned in a certain way, we'll do X, Y, or Z. So if you're smart enough to know what all the variables are, then you'll know what to do at any given point in time, during that economic cycle that it's occurring. But again, it's not a science. And there have been plenty of instances where, for example, hedge fund managers who came up with great algorithms for investment worked for a while. But then what happened? Other investment hedge fund managers came up with similar algorithms, and all of a sudden that original algorithm no longer outsmarted the market because you had all these other competitors doing the very same thing. And so some of the smartest people who came up with the original hedge funds and those algorithms lost their shirts. Jerry knows a little bit about that. He can tell us. Well, we're at 8 o'clock, guys. So unless there's any last minute words of wisdom you'd like to share with everyone, we'll conclude the course on money, banking, credit.
Just one thing, Ed.
Yeah, sure.
I put a link in about Michael Hudson. There's been in this monetary history, there's quite a battle between the MMT folks and the monetary reformers.
Yep.
And Hudson, in that clip, right where I've queued it up, for about 5 minutes, talks about the Chicago plan, and he sees it as a part of MMT, which I thought was an extraordinary statement and would help to bridge the two groups who have a frictional relationship. Thanks very much for everything you've done. That's been a great series.
I like to say one thing. While I'm with you guys, people say phone listens to you. I just got a news feed saying Bitcoin is officially a new asset class. Goldman Sachs.
Yeah, well, financial markets have been really great at introducing new opportunities for people to speculate.
Yeah.
And it's just like, with, the over-the-counter assets that were sold, without really understanding the underlying implications. If there's a bond introduced that says it's AAA rated by Moody's, well, you think you can trust that. But, with the subprime mortgage market and the private label mortgage-backed securities that were issued to serve the subprime market, a company like Moody's had no expertise to evaluate how well those loans were underwritten. And so it was a false sense of security that investors had because Moody's rated those bonds as AAA bonds when they were really junk bonds.
Yeah.
So the word to the wise is be very careful. Whenever the opportunity seems too good to be true, it's most likely too good to be true.
Interesting.
Giannis, you haven't asked a question, so I will give you the last opportunity to speak tonight before we sign off.
Thank you, Ed. I wanted to echo a little bit on what you last said. And let me say that Dutch tulips were also a big and very coveted speculation asset. And that's what Bitcoin is. However, both have some technology about them. Tulips, you need to know how to cultivate them, how to protect them from the elements and everything, so that there is know-how. And the same is with Bitcoin. However, one should be able to see how much investment has gone into the technology and how much of that is reflected into the current price. I would say that the divergence would be extremely high, which is also the case with most of the technology stocks. So we think it's technology, but actually it's a speculation tool on the back of technology. So, and that goes for pretty much 99% of stock market. So we should be very careful. And one very obvious way to see that is the price to earning ratio. The price to earning ratio, it has to be at least 10 for somebody to say, oh, this is a worthwhile stock to invest in. But the price to earning ratio, 1 to 10, tells you that it's 9 times rent, 1 times capital. Okay, so that proves in their own words that actually the stock markets are rent-seeking markets. And I would like to join with that. Thank you, Ed, and thank you, everybody.
All right, Giannis. Yeah, look, my view, right or wrong, is that the stock market has evolved into a gambling casino. Were there ever fundamentals at work, where the underlying value of a business entity issuing shares of stock would result in the capitalization of its income stream into a selling price? I don't know. Maybe that at one time occurred, but my own view on that, which could generate another hour-long discussion, is that if we had laws that required corporations to distribute earnings net of retained earnings that were specifically retained for organizational growth, for R&D, et cetera, then that would say something. If a stock that was valued, if a stock that issued $5 per share every year, and the market rate of return that was acceptable to most investors was 5%. That would mean that that $5 was a return on a capitalized value of 20 times $5 or $100. So the stock, the share, the stock would have a value of $100. Now, the investors might say, I expect the dividends to go up. And so I will pay more today than $100 for this stock because I think next year their potential for profit and distribution of dividends might be $7. Now, are any of those fundamentals still working in the stock market? Or is it simply a response of the supply and demand for investment opportunities by, investment houses that have billions of dollars to move money around, every day? So that's my view. And since I guess I taught this course, I get the last word. So we'll maybe have a discussion about that particular comment that I made at some other time. So, hey, look, thanks everyone for sticking with me on what has been a very complicated story. And I hope that you've learned something from our weeks together. And I hope it's helped you in some way. So much appreciated. Thanks for your time.
Thank you. And we hope to see you all soon. Just to remind you that Tom Greco is going to be back again on June the 4th. And we have another session, the final one on the 18th. And I hope to see you on June the 4th. And I also hope to see you again when Ed comes back with a new course. Thank you.
Good night, everyone.
Good night.
Good night.